Hello guys and welcome back to another video. So this time we're going to speak about Palantir, Airbnb for a change. My God, I've been making too much Palantir content. So Airbnb is actually a brother or sister company to Palantir because one of the first investors into Airbnb, fun fact, was Peter Thiel, who was also one of the co-founders of Palantir. So I'm always on lookout for new stocks, and this stock really piques my interest. And as I always say, the question is, you need to find great companies at great prices. And this is a great company. It has been falling like crazy, like everything else. I got the question, is it time now to buy into Airbnb? Here we go, guys. So the stock IPO'd at the end of 2020 in COVID times, and the stock IPO'd at around $130. And then it went to its high of just over $200. And then since then it fell down to over 50% to $97.48. So is this stock a buy now? As always, if you like this content, please make sure you hit the subscribe button, which is down below. So let's get into the meat of this video. So Airbnb is a fantastic company that is currently super hard to value because it's been devastated in COVID, and then it has come back very, very strong. And I want to show you some strength that this company has, and then I want to show you some weaknesses, and then I want to show you my initial numbers for this company. So one thing that is crazy good with this company is they have a gross margin of about 80%. You can see how the gross margin gets stronger and stronger, and that makes sense because they don't own any real estate. They are basically a platform that connects buyers and people who want to rent out their homes. And it's one of the very few businesses that customers also really like, but also the people who want to rent out the homes, really, really like. So they're, loved by both buyers and sellers. It's a very interesting business model. Then the business is generating quite significant operating cash flows. I believe that the last trailing 12 months of free operating cash flow is at $2.8 billion. They have very significant amount of money on the balance sheet. They have some debt, but I believe 3.6 times more money than debt on the balance sheet. So they could pay back all the debt that they have. So they're very well set up for recession if it's coming. We don't know if it's coming. We all suppose that it's coming. And what's so nice, so they're free cash flow positive already. They're not positive in the bookkeeping because of stock-based compensation. You see, it does feel like a Palantir video. Palantir also has 80% gross margin and also is not profitable because of the stock-based compensation. But yeah, I digress. So they are very well set up for recessionary times because they're not dependent on loans. However, if there comes another COVID, then they are going to get decimated. So now, if we look at their numbers, basically you almost have to take out the year 2020. And also what they're doing is that they're comparing this year, 2022, to the year 2019. So they're almost making like 2020 and 2021 never happened. And as you can see, they have an 80% growth compared to 2019. They are very nicely, you can see, inching closer to being GAAP profitable. Only a 19 million loss in Q1 2022 compared to a 1.2 billion loss in Q1 2021 just a year prior. So that's a very, very nice increase. And here you can see that adjusted EBITDA, when you take out the stock-based compensation, then they are making money. So here's the thing that makes them very hard to value is we don't know how much of a pent-up demand this increase is. So if we say that, okay, the 2 years, 2020 and 2021, they disappeared. So, we shrink together. So the numbers that we use is it goes from 2019 to 2022. However, how do we know that if they're increasing 30% year over year, that it's not just pent-up demand and then it's going to level out in 2023, especially maybe also because recession is coming and people are going to cut back on the travel. And this makes this stock hard to value, and obviously uncertainty is not good for the stock price. However, I did my best effort and I want to show you what I came to. So to account for the risk that maybe there is a lot of pent-up demand and they will level out in the expansion, I looked 10 years into the future and I counted with a 20% growth rate in revenue. You can see that their current market cap is $61 billion, and this gives them a PE of 76. They had a free cash flow of 2.8 billion, as I said. Currently, they're at 10 1.22 price to sales ratio, again, which is still, it feels high. Normally for tech companies, you know, a price to sales ratio over 10 is high, 7.5 is, you know, fair, and around 5 is very cheap. So you can see that the stock has fallen 50%, but still the price to sales is still on the high side. Then we have the growth to PE ratio. And again, a big part of this is my assumption of how fast they will be able to grow. Obviously, this, if you say that they're going to grow 30% per year, then the PEG will change to 2.5. I'm still going to account with the 20%. And on the PEG ratio, you want to have below 2 to make it attractive. And whichever way you calculate, it's still over 2. And if you believe in the 20%, it's significantly over 2. It's 3.8. So again, just in that method, it still feels expensive. However, what's very tricky with this company is that they're on the cusp of profitability, and they are a platform product, meaning that they have a network effect, meaning that the more people list apartments, the more customers find the website valuable. And the more customers there are on the website, the more people who rent out apartments find it valuable. And this also makes it a gigantic moat because it becomes really hard to start an Airbnb competitor. And as far as I know, they basically have a monopoly in what they're doing. And again, this is something that Peter Thiel really likes to invest in. And obviously, if you ask him, he's going to say, no, this is not a monopoly. They compete with hotels. But if you, which is true somewhere, but if you look objectively, there's not another company that I know that does the same as Airbnb. And this can lead to huge efficiency increases because they don't really need to increase their personnel. You know, they don't really need to increase their costs. And if you look deeper into their reports, you will see that their revenue has grown a lot, but their fixed costs are barely growing. And I think that what's going to happen in the future is that their fixed costs are going to be barely increasing while their revenue is going to be growing, and they are going to be turning into more and more of a monopoly and more of a cash flow business. So I really, really like this because I really like to invest into companies where, you know, you can put your money into it and just, you know, watch the quarterly reports and you know that they're going to be around 10 years from now. You're taking very little risk and it's a transformational company that is, you know, in the S-curve going up. I'm a lazy investor. That's all I can say. I run a real estate business where we are building hundreds and hundreds of apartments, and I run this YouTube channel. And honestly, I don't have time to micromanage my investments. So I want investments that I need to buy once and then I can safely hold for 10 years. And I know that it's going to be worth more money. And I already know that this is the case with Airbnb. If you buy it now, it's definitely 100% going to be worth more than what it is today in 10 years. So the question is it going to be $1 more or is it going to be 10x more, right? To show you the calculation, I added 5% to their operating margin every year going forward. I am supposing that they will be profitable, GAAP profitable in 2022 with a profit margin of 5% and then 10% the year after, 15% the year after, 20% the year after, and 25%, and then level out at 25%. Again, very hard to predict because of the COVID mess up, but I feel this is a very safe assumption. Then I looked at the share count and I think that they're going to dilute the stocks at a rate of 3% per year. If I count with the PEG that I want to calculate, then we take, as I said, I'm interested in 2025 and 2030. What is the stock going to be worth? So if the profit is 2.4 billion in 2025 and you slap a P of 40 on it, which is a 2 PEG rating, so it's still on the high end, it's not super conservative, then the value that I get is 100 billion in market cap, which would result in a share price of 143. With the same method, we would get a 257 billion market cap in 2030. I'm gonna make my head smaller. So here's the nice thing with my calculation. So the stock price currently is trading at $97, right? So we still have a 50% upside in the next 4 years. And, you know, the question is that good for you? I like to invest in companies where I am aiming for a 30% return for many reasons, because, you know, when you're aiming for such a high return and your thesis is completely shitty and you effed up on your calculations, you know, you only make 15% per year on a compounded annual return, it's still nothing to cry about, right? So I like to think like this. So if I would want to have a 30% compounded annual return, the stock price would have to be $50 today for me to be interesting. At 2030, it would have to be $30. So for me, it's not a buy now, but I want to stress that this was a very surface level, you know, quick research that I did on the stock. It's a superb company, so I'm definitely going to look deeper. And if you're okay with having 15% per year return, your target stock price could be $82. And again, if you sign up for Patreon, you can play with this table and, you know, you can add in your numbers and see if, you know, what your assumptions, because maybe you will say that they're going to grow 30% per year. Maybe you're saying that they're going to have much higher margins. And if the growth is bigger, you know, then the PE that they should get deserves to also be higher. So this is, again, I want to stress how conservative this is. And it's not out of the realm that if we haven't bottomed out, that the stock is going to go to $82. So I'm not buying this stock now, but I'm definitely going to do more research on it, because it is a very intriguing company with a very solid business model, with a super high moat, and they are basically a monopoly in what they're doing. And it's definitely an investment that you don't need to micromanage. Thank you so much for watching up to this point. Let me know what you thought. Let me know what your price target is, and if you have Airbnb currently or not, and if you're planning to buy Airbnb. Thank you so much again, and see you in the next video. Bye bye.